Welcome back, traders and investors, to finish up HFT Friday. We have Chris Nagy and Dave Lauer on the line, and they are the president and CEO of the KOR Group, LLC. Chris, can you talk about KOR Trading and your mission?
Oh, you bet, Joel. So essentially, Dave and I came together from two totally disparate backgrounds. I had always focused on the retail trader, and Dave was a high-frequency trader. So it was kind of ironic that we agreed on a lot of views. And what we've done, we've always been active with market structure. So what we've done is essentially built out a lot of market structure information that we provide to buy-side firms, exchanges, institutions. We do a lot of research. We look at a lot of the various statistics that are out there. We do education workshops. We also do a lot of lobbying. We were in D.C. yesterday and the day before, actually, visiting with Congress and the SEC. So we kind of cover the gamut with market structure.
Okay, this is a question for the both of you here. Why is Alibaba listing in the U.S.? Why not Singapore or another Asian market, as it's not as well known here?
So I'll take it, and Dave, maybe if you want to kick in, go ahead. Yeah, it's a great question. It's almost being overlooked today, and I think it's a really important one. Like, why isn't Alibaba listing in Singapore, Asia, or somewhere else? Because it's just not well known here in the U.S. And the real reason behind it is the U.S. is one of the few structures in the world where we allow dual class structures. So that would be Class A and Class B shares that trade on an exchange. In the case of Alibaba, what's coming public today is the Class B shares. There's still a big Class A segment out there. So essentially buying Alibaba as, you think you're a shareholder of the company, you're going to have a vote, which in the case of Alibaba you will, but you get one vote per share versus the Class B shares where you get 10 votes per share. So effectively, there's like 28 people that really control the running of Alibaba. And it's a phenomenon that kind of resurged, used to be in our structure a long time ago, back in the 60s and 50s, where we had dual class structures, and it kind of went away. But it started to come back with initially Google, which has a multi-class structure, and Facebook, which was one of the newer ones that has a multi-class structure.
Dave, your comments.
Yeah, I mean, that's, a lot of it just comes down to exactly what Chris is talking about and governance issues. And, there was an interesting quote from someone at Alibaba that actually ringing the NYSE bell was a factor, not a determining one, but an attraction. And so as we talk about HFT and the loss of the trading floor and the disappearance of human traders, one of the appeals to Alibaba was actually ringing the bell, as funny as that might seem to some of us.
Chaim, I'm going to throw the next question to you. Earlier on the show, we discussed the tick size pilot. What are your thoughts on the pilot? Is it achieving its desired goal?
Well, I mean, the thing that I'm most excited about is the trade at requirement that requires off exchange venues to be to be basically match to be having a bidder offer matching the price has to be displayed before it can trade. I think Dave Lauer and Chris are they were central in kind of pushing that angle, so they're better to talk about that. But that's really the feature I'm most excited about with the pilot.
Dennis has been saying that the price improvement requirement of half a cent is too small to encourage displayed liquidity providers. What are your thoughts on that, David, Chris?
Yeah, we completely agree. So as Chris mentioned, we've been meeting with the SEC and Congress for the last couple of days, and the tick size pilot has been a major topic of conversation. We'll be filing an extensive comment letter, but we have a lot of concerns about the proposal, and the two primary ones are the structure of the trade-out rule that they've included and the half a cent of retail price improvement. So, when you consider today the level of price improvement and the width of the tick, you generally are looking at 30 cents of payment, and then you have 70 cents to work with as a wholesaler because the tick is a penny. Now, when you're talking about a 5-cent tick, if retail orders are exempted from the trade-out rule, then they just get the half cent of price improvement, and the wholesaler has 4.5 cents to work with. So we would not be surprised to see a spike in payment rates and a further distortion in the market in terms of order routing and payment rates being measured in pennies per share rather than mils per share. And so, even though this is a small part of the market, generally estimates I've heard are about 3% of traded value that we're looking at here. And the SEC has been clear that this test of the trade-out rule is not an endorsement of the trade-out rule. It still seems to us that you want to make sure to get this right because it's going to have significant implications on further developments in market structure. And this is one of the more data-driven tests that we've had. So to get this right is critically important. We'd like to see much more price improvement, probably to the midpoint, and we'd like to see a much simpler trade-out rule. In Canada and Australia, the trade-out rule is 3 sentences. It couldn't be simpler in those countries, and for some reason we get 2 pages with lists of exemptions reminiscent of the trade-through rule and just layering more NMS on top of an existing set of complex NMS rules.
Yeah, and what Dave said is it's kind of scary, actually, because when the SEC proposed this trade-out pilot, it was fairly simple. However, what the exchanges delivered back was really complex with a lot of exemptions and innuendos and increased complexities. And in some ways, the SEC's backpedaling on it a little bit, as was evidenced by Steve Luparello, who mentioned at the trade conference and in our meeting with him that this trade-out pilot isn't really an endorsement of trade-out. What's scary about it from a trading perspective is if you're trading a stock now that's going to go to a nickel spread, you put in the trade, you get a half a cent of price improvement, but you've got a 5-cent spread on the other side. Will the purported increase in liquidity kind of offset that? And we're not really sure, given some of those carve-outs. It might be very dangerous for a retail trader to want to engage in trade in these simply because of the increased spread and the lack of any real substantive price improvement.
Chaim, the IEX is looking into bringing in broker preferencing to the U.S. markets. Could you briefly discuss that and give us your opinion? Isn't it just another way to hop the order queue?
Yeah, I mean, I'm not really a great fan of any type of allocation or advantage where you can get 100% of the order. So they've already implemented that. One way to interpret it, if you're sympathetic, is that if brokers would be unlikely to bring order flow to certain brokers would be unlikely to bring order flow to IEX if they couldn't cross up their own order flow, and that's what the feature basically allows. But what I'd like to see in the U.S. Equities market is similar to what goes on the options market, where preferencing means you get a piece, but you don't get the whole cross. So that would be my main concern about the broker preferencing on IEX is that it's provides an advantage for that makes it difficult for people who don't have capital or order flow to kind of compete in the trade.
Okay, Chris, your comments on that.
Yeah, so thanks, Joel. So I wrote an article about this that I put up on the Tab Group site and a couple of other different sites in our core trading site, just about IEX's preferencing model. What's interesting about it is it's not really new. Models like this were around back with the old Cincinnati Stock Exchange and the Boston Exchange, having been in the markets, I saw firsthand what some of the benefits of them could be. So many times what happens, especially for a retail trader, is your order actually goes to a broker. And in the case of our current, HFT structure, it's nearly impossible for any retail trader to get at the front of the line. With preferencing that IEX has, there's actually an opportunity to, have some availability to be at that top of the queue, if you will, to get your order executed through some of the broker preferencing processes that IEX is bringing. And I just add that it's not unusual. We've got some instances in the markets today of smaller markets that are doing something like this. NASDAQ's Pacific piece has a priority mechanism, if you will, or a preferencing mechanism. So does NYSE, actually, with their retail price improvement program, where you're essentially broken down into different classes of investors. So, it's not a totally new structure at all, but it's a structure that hasn't really been prevalent for the past decade or so in the market.
Okay, Chaim, we're going to go to you on this one. The regulators have so many sources available to look at the HFT markets and get them straightened out. Where should they focus their efforts?
Well, I think that, again, I'm probably biased here, but it's very hard to, determine the way forward if you don't, have a system that is strongly documented and also that can be audited correctly. So, what the focus is now is data capture and ensuring that the exchange operating rules are thoroughly documented and that HFTs are abiding by them. And it's going to take a while. The SEC has the system Midas for data analysis, but I think most of us in the business would know that that let's say sophisticated trading firms have stronger capabilities of data analysis than Midas would give, and so we'd like to see more more investment there, I imagine. And then what you've seen in this past 2 months is you've seen a lot of disclosure by exchanges in response to Mary Jo White's demand that they document certain features by, I think there's a deadline in October, November, somewhere in there. And I'm starting to see features disclosed that I didn't know about, and I thought I really had a handle on everything. So that's where we are now.
Chris and Dave?
Yeah, it's a topic that I've spent a lot of time on. I wrote 12 pages of testimony for a CFTC appearance earlier this summer that, in which I explored how I think regulators need to approach this issue of getting data and doing research and understanding the market. I'm in complete agreement with Chaim in terms of their need to really get to the same level as existing participants, and I think they need to get beyond that. I think the regulators need to have a better understanding of markets than participants, and I've said many times that I think Midas has some extreme shortcomings. It's only as good as a ticker plant that almost everyone on the street has. It doesn't have a privileged view into the market, which is what the regulator should have. Regulators aren't surveilling properly. They're not surveilling in a sophisticated enough way. Cross-market surveillance is lacking. Cross-asset class surveillance is non-existent. This is a huge concern that I raised in front of the Senate Banking Committee last month, that nobody is watching the futures and the options markets together. It seems strange to me that that's still the case years later after this issue was first raised. I think that regulators really need to focus on technology and data, but they also need to focus on different ways to engage the industry and practitioners and researchers. And as I've said many times before, they need to open up access to the data, open it up to researchers and academics who right now only are able to get data through conflicted sources such as the exchanges or high-frequency firms. And they could also try some creative approaches like prize-based mechanisms or sharing percentages of the fines collected to engage people to develop better manipulation detection algorithms or more interesting studies in the market. I think that there's a lot of ways for the regulators to be creative within the confines of the resources that they have today. And I'd like to see some pretty fundamental shifts in culture to achieve that.
Okay, final question here for Haim here. Any or just some advice for traders trying to navigate this HFT world?
Well, the typical advice I give is to challenge your broker. Look at their order routing Rule 606 reports, and find out if where they're executing with what market makers they're executing with, what exchanges, and I would say challenge them on whether or not their order routing is choosing venues that are trying to address the problem. And if you see if there are venues out there that have been defending the status quo and are being heavily investigated, and those are venues that you may be concerned if your broker is choosing them as the primary venue.
Chris and Dave, final words.
So I'll start, Dave, and then you can jump in. So I think my first piece of advice, earlier I was listening to the program and you guys were talking about the open, and retail, typically you see a lot of volume on the open, and I'd say, boy, stay away from the open. There is a lot of arbitrage that goes on there. There's no price transparency at all. It tends to be a large part of retail, and there's really no rules or regulations for the benefit of the markets that don't kick in until well after the opening. So I'd stay away from that. Just in terms of broker selection, we spend a lot of time on this, and we see huge differences in terms of price improvement, payment rates, et cetera, with brokers. So it's not just the commission that you pay. You have to look at, what are you getting on the overall trade? I think what we'll actually do is we collect a lot of this data, so we'll push some of it out free on our coretrading.com website today if people want to take a look at some of the statistics, because they're hard to find. In fact, when we were at the SEC doesn't even have a database of 605 and 606 data, which is kind of unbelievable to think about. So we'll push it out, and people can take a look at it. It might be helpful in that regard for free. So take a look. Dave, what do you think?
Yeah, we'll tweet that out today, and we've also rolled out a service for more geared towards the institutional buy side for helping them understand how their brokers are routing their orders, how broker algorithms are achieving execution quality, and really doing a holistic qualitative and quantitative review. We're trying to make data from those types of analyses available to the public, but we also have to keep in mind sensitivities around customers and clients. So, for institutional buy side, they have some interesting services that are becoming available for helping them achieve best X and measure execution quality. On the retail side, it's really about focusing on your broker, exactly what Chaim and Chris are saying, asking the right questions and encouraging brokers to connect to other venues such as IEX, and keeping tabs on where your orders are going to the extent that you can.
Okay, a big thank you to Chaim Bodek, founder of Trading Machines and Decibel Capital Markets, for co-hosting the back end of the show to me. Chaim, thanks a lot for coming on.
Thank you.
And also a big shout out to Dave Lauer and Chris Nagy of KOR Group for coming on, discussing the Alibaba IPO as well as market structure. Great to have you guys on. Thanks for staying on a little bit long, and we'll certainly include you in our next discussion.
Thanks, Joel.
Sounds
Happy
great.
to be here.
Thanks.